China. Because as it turns out, China knows all of this, and China's been building that system since as early as 2009. So here's what happened in 2009. Right after the global financial crisis, Lehman Brothers just blew up, the whole Western financial system got shut down, and the Federal Reserve was printing money like crazy to save it. And China is just sitting there holding trillions of dollars of US treasuries, watching all of this thinking, wait, hold on. Our whole national savings account is an IOU from a country that just printed unlimited amounts of money for a problem they just created, devaluing our wallets. So in March of 2009, the governor of China's central bank published an official paper called Reform the International Monetary System. This was China's Jerome Powell, basically saying, quote, the desirable goal of reforming the international monetary system is to create an international reserve currency that is disconnected from individual nations and is able to remain stable in the long run, thus removing the inherent deficiencies caused by using credit-based national currencies. What this means is the world's savings account should not be stored in one country's funny money, right? We need something neutral, something no one controls. Then the guy in charge of China's central bank was like, maybe we should revive that one idea from the 1940s, from a guy named John Maynard Keynes. And the idea he was referring to was a neutral international currency called the Bancor. The Bancor was based on a basket of about 30 commodities, and its whole job was to keep trade between all the nations of the world perfectly balanced. Right? Long story short, the way that it was supposed to work was if you ran a trade deficit, the system punished you. If you ran a big trade surplus, the system also punished you. Under Keynes' system, the whole game of one country hollowing out another country's factories would never happen because the system would automatically correct it. Now, at the time of this proposal, the United States was like, nah, we're good. Why? Because in 1944, the country that was running the giant trade surplus against the world was the United States. The US was the China of the world in 1944. We sold everything to everybody. And so we didn't want a system that punished surpluses. So Keynes' idea got thrown out, and instead the world got the dollar system. How do we know this? We know this because the US trade representative, Jameson Greer, literally said all of this at Davos.
Many of Keynes' most creative ideas for how to deal with this problem were left on the cutting room floor at Bretton Woods. He wanted a global currency, things like that. The system that emerged did not have a completely structural mechanism to discourage imbalances. And to be honest, the United States had a big trade surplus at the time, so maybe that had something to do with it.
That's what he said. It's kind of ironic that in 2009, China quoted Keynes to the world and said, the dollar system's broken. We need a neutral reserve asset. And nobody listened. And then 17 years later, the United States is now on the losing end of the system that it designed. And it's now the US that's quoting the same economist, making the same argument. Right? The point is, they're telling us the system needs a neutral reserve asset. And by the way, it's not just China asking for this. In 2010, the president of the World Bank, Robert Zoellick, who was the former US Treasury official, wrote an article in the Financial Times saying the world should consider using gold, quote, as an international reference point for the monetary system. In 2016, a guy named Ken Rogoff, who was the ex-head economist of the IMF, he wrote that emerging markets should convert a big chunk of the trillions of dollars they hold in reserves into gold. And then he wrote, maybe the most important thing you'll learn from this video, he said, gold, quote, despite being in nearly fixed supply, does not have this problem because there is no limit on its price. So tying all of this together, thanks to Luke Gromen, Keynes in 1944, China in 2009, the World Bank in 2010, the IMF's former chief economist in 2016, and now Greer and Besant in 2026, the point is, they're all versions of basically the same thing, which is a return to a neutral reserve asset to balance global trade. And there's only one asset that's ever actually done that job. Now the problem is, Gold cannot do that job at today's prices because it's just too low. For the math to work, the price has to be much, much higher. The estimate for how much higher gold has to be is $38,000 per ounce, roughly. That's when the biggest trade imbalance, which is with China, would be balanced. Okay, so if this were to be true, and if this theory is partially right, then how would we know? What's the evidence, and what would we start to see? What we'd probably start to see is countries and central banks buying a lot of gold. And it just so happens that's exactly what we've been seeing. Remember those charts from the beginning of the video. Watch what happens when you look at them again now that you know what the plan might be. The People's Bank of China buying gold for 20 straight months, including their biggest purchase in almost 3 years, while the price was crashing 30%. That's a central bank that does not care what the price is because they're not trying to make money. They're accumulating an asset that they think will probably run the world in the future. Also, world central banks as a group have been buying roughly 1,000 tons of gold per year for 3 years straight, which for context is about double the pace of the decade before. Then there's also countries like Poland, Uzbekistan, Kazakhstan, China. And notice who's selling. Almost nobody. And remember that paper gold ban that China just did. It starts to make a lot more sense because if gold is going to be the neutral reserve asset, the last thing you would want is a giant Ponzi scheme of paper claims sitting on top of the real metal, suppressing its price, allegedly, right? China wants its citizens holding the real thing. Coins, bars, ETFs backed by bullion in a vault somewhere, right? Not somebody's IOUs with leverage and a futures contract on top of it. So it kind of looks like then that China is depaperizing gold before this possible revaluation. And while all of this is happening, by the way, look at the gold exports for the US. This shows something called non-monetary gold exports, which is a line that's going right up, right? The biggest increase in the history of the data. And it started right around the fourth quarter of last year, which happens to be right after US and Chinese officials got together. What this means then is the United States is literally shipping gold to China right now in record amounts. And Luke Gromen predicted this. He said that under this Hamiltonian system of economics, the US will have to export a lot of gold in USD terms to China for some time. It's already happening. Now hold on. Where does this $38,000 an ounce number come from? Because I know it sounds insane. Here's how they arrived at this number. You take China's last trade surplus, which is around $1.2 trillion or so. Now, China's gold imports last year were 940 tons. And if you divide the surplus by those tons, meaning if China were to settle its trade surplus in gold, the price where the math balances that would be roughly $38,000 per ounce. That's how that number was made. Trade surplus divided by gold. Now, at today's price, gold is just too cheap to settle world trade with. But at $38,000 per ounce, it covers most of it. So let me tie all of this together. Luke Gromen's argument is that there's really two ways that this story ends. The first way is the whole MAGA plan fails. This is where reindustrialization does not happen, the debt keeps on growing, confidence breaks, and the financial system we've had since 1971 comes apart the bad way, which is the way that it came apart between 1922 to 1945, which, as a reminder, included a depression, currency collapses, and a world war before the system replaced the old one, right? Now, I hope that is not the path that we take, but little by little, that seems like where we're going. If that's what happens, gold would skyrocket, because gold is what people want when these paper systems break. Now, the other outcome is maybe this plan works. Maybe the US actually reindustrializes, and trade gets rebalanced, and the world transitions in a controlled, managed way to a system where gold is that neutral reserve asset that settles trade, like China asked for in 2009, like Scott Bessent is talking about right now. That would be the preferred path, right? But either way, both roads lead to the same outcome. The only variable we don't know is how fast or how painful that process is going to be. So then the question is, well, what does this mean for our portfolios? Obviously, this is not financial advice. I'm a guy on YouTube who used to do card tricks. But the most likely outcome, I think, is that we'll see a capital rotation from financialized America into real world America, right? Real infrastructure stuff and commodities. Now, in that world, inflation will outperform the dollar, the stock market will outperform inflation and the dollar, and gold will outperform everything else. And so far, that's already started happening. Starting from early 2018, when the first China trade war started, it shows the S&P 500 is up 161% in dollar terms, which sounds amazing, but when measured in gold, it's actually down 15%. Long-term treasury bonds, which are the safest assets in the world, those are down 31% in dollars and down 78% measured in gold. Gold miners are up over 200%. So the dollar prices that are on our screens are kind of an illusion, because when measured in real money, money that cannot be inflated, right? The safest assets on earth have actually been the worst place to be. And the best place to have been was the shiny rock that everyone told you not to buy. Now, does this mean then that gold is going to go to $38,000 an ounce next week or next year? Probably not. That's not going to happen overnight. There's still a lot of accumulation between nations and central banks. And the crazy part is, though, none of this is actually a secret, right? It's in the Wall Street Journal. It was announced at Davos. It's kind of hiding in plain sight, and people are just not listening to this. I think if people understood this, they would probably be hoarding more gold than they are today, which would obviously be counterproductive for the central planners. Personally, I think this could take more than a decade to play out. These things take a very long time. So if you're watching this video and you have FOMO to go out and buy gold right now, this is not a video to go and get you to buy gold. I think this is going to take, again, a long time for this to play out, and there will be major corrections along the way, even for gold. Just remember, if this theory is true, there's a difference between being right on the direction and being right on the timing of when to buy it, which is also why I personally don't hold any gold yet, but I'm watching it every day to see if I can get a safer entry point. When and if I do decide to buy it, that video will most likely live in the premium member section where I post my videos earlier and I post extra thoughts on the economy. If that's valuable to you, the link is down below. Thank you so much for watching. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next time. I'll see you soon. Bye-bye.